Crypto investing strategies. Dollar cost averaging explained. Dollar cost averaging is an incredibly effective but oft overlooked investment strategy. It is a simple and easy way for investors, in both traditional and crypto markets, to build positions while minimizing risk and emotional responses to market volatility. Emotions, be they fear or overconfidence, can easily overwhelm the most experienced traders and investors, especially in volatile markets such as crypto. For example, Bitcoin's price falling significantly over a short period should, in principle, represent an enticing opportunity for those with long-term convictions. However, uncertainty often pressures investors to make the exact opposite decision, and many sell at prices nearing potential bottoms. Similarly, when the price of Bitcoin surges, those who sold their holdings near the bottom may be enticed to buy in again, often at much higher valuations. Dollar cost averaging removes such emotional human decision-making from the investing process. Those following this strategy make buys at regular intervals rather than spontaneously based on market optimism and their emotional state. In this article, we're focusing on the dollar cost averaging strategy. You'll learn what it is, why it's popular, and how to increase your chances of long-term profits by using it. Finally, we consider how to create and execute a basic dollar cost averaging strategy here at OKX. What is dollar cost averaging? Dollar cost averaging is a strategy that investors with a strong belief in an asset's future price appreciation can use to build a position over time. Rather than saving and investing a lump sum, those who employ a DCA scheme instead make many smaller purchases at regular intervals, irrespective of the asset's recent performance and latest price. A simple example of DCAing would be if Maxwell, seeking a long-term BTC position with $1,000, set a schedule to buy $100 worth of BTC each week, irrespective of the price, instead of buying $1,000 worth of BTC at once. Maxwell's strategy mitigates the risk of making a large investment at an inopportune time, because his incremental buy orders are smaller than a lump sum investment. Declining prices shouldn't be as likely to prompt an emotional response. Instead, lower prices represent a more attractive entry point for Maxwell's next scheduled buy. Many retirement plans around the world use a form of dollar cost averaging. For example, a 401 plan in the United States involves an individual allocating a portion of their paycheck to various investment vehicles at regular intervals, regardless of recent price action. Dollar cost averaging is a powerful strategy and is popular among different investor types, including beginner investors who might lack the technical chart reading skills to time entries based on recent price action, investors with strong long-term conviction in an asset's future performance and appreciation, those seeking to reduce the influence of emotions on their decision-making, investors who have a set amount in terms of capital and want to maximize its effectiveness in a volatile market. Investors might not have access to a lump sum of capital to take a sizable position, but have a regular income source, for example, from employment. Illustrating the power of dollar cost averaging. Although it's an incredibly simple investment strategy, DCAing has consistently proved profitable in volatile markets like cryptocurrencies. The following examples should illustrate the power of dollar cost averaging. Adam is bullish on BTC and has $1,200 with which to take a position. Unfortunately, he decides to enter the market on December 20, 2017, just days after the bull market peak, when BTC was trading at $16,462. Over the next 12 months, he watches his investment lose more than 65% of its total value. By November 15, 2018, BTC's price is at $5,647, and Adam's position is worth around $420. Olivia is also bullish on BTC, but for the long term, and has $1,200 to invest. Instead of taking a position with the whole $1,200, she chooses to dollar cost average with monthly purchases of $100 for the next 12 months. Each month, she buys $100 worth of BTC, and as the price continues to drop, every subsequent purchase buys her a little more BTC than the previous buy. Rather than regretting her initial entry and praying for a speedy price reversal, Olivia may in fact hope for lower entry points to build a larger total investment. Over the same period, Olivia's overall investment is in a much stronger position than Adam's. Instead of facing $780 in unrealized losses, Olivia would be down just $343 if she sold, and she would benefit from an overall larger position. In addition, if the price reverses and begins climbing again, she would be in profit much quicker than Adam would be. Adam could only sell at a profit when the price once again exceeds his entry point. In BTC's case, that would occur in December 2020, a whole 3 years after making his initial entry. It would take a lot of conviction on Adam's behalf for him to hold his BTC during such a prolonged bear market. Olivia, on the other hand, becomes profitable much quicker. Her average price would be the sum of each entry divided by the number of entries made. In the above example, Olivia's average entry price is around $8,065, considerably less than Adam's $16,462 entry. As such, Olivia could sell her 0.1516 BTC for slightly more than the $1,200 invested as early as mid-2019. The chart below visualizes this example, where the red and purple lines represent Adam's investment, while the blue and green lines represent Olivia's. It's important to know that a dollar-cost averaging strategy does not guarantee greater profitability than lump sum investing. For example, let's presume Adam was much less unlucky with his entry. Instead of buying the 2017 top, he bought just over 0.22 BTC for $1,200 on March 18, 2020, when the price was around $5,340. 1 year later, the price would be $47,858, and his investment would be worth more than $10,000. Meanwhile, presuming Olivia was dollar-cost averaging over that same period, her potential profit would end up being much smaller. As the BTC price rose throughout 2020, the amount of BTC she bought each month would shrink. After 12 months of DCAing, Olivia would have only 0.76 BTC, which she could sell for a much smaller profit of $3,950. This second example probably makes dollar-cost averaging look like a much less appealing investment strategy. However, it's important to recognize just how difficult it would be to make the March 2020 lump sum investment. BTC's price crashed from above $10,000 in February 2020 to well below $4,000 in mid-March. With just about every global market tanking, investing in such conditions would require absolute emotional detachment and unbreakable confidence in BTC's future price performance. In reality, few investors and traders, if any, are capable of timing the market with such conviction and accuracy. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.